Now is the time to be doing some tax planning, especially if you're a head of household filer. There's a huge surprise you need to be preparing for. I'm going to help you do so coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so our team of financial professionals here at Korhorn Financial Group, we do comprehensive financial planning, and then we have experts, CPAs, insurance professionals, attorneys, and so on, all working together under one roof to provide you with wise financial advice, financial wisdom. That is what's missing. So you're not going off to Flow and doing your own taxes and then talking to this person over here and have everything disjointed. It's got to be all together so that you can make wise financial decisions. So as part of that, lots of people say, hey, can you just prepare my taxes too? And we're like, yeah, of course, we'd love to. And so we do, I don't know, about 5,000 tax returns a year for clients that we serve, which is great. Well, there's tons of tax planning that comes out of that, all with the objective of helping you pay the least amount of tax over your life. But through that experience, we've seen a lot of tax surprises, and I want to help you avoid some of those. Tax planning is all about avoiding surprises and capturing opportunities. So let's avoid some surprises here. If you are a head of household filer, for whatever reason, divorced or widowed, or whatever the reason is, if you're a head of household filer, not for no reason other than just that's how the tax system works, you're going to see an enormous tax change when that child is no longer a dependent. When you move inevitably from head of household filing to single filer. You will. There's no way around it. I guess if you just keep adopting kids and keep adopting kids and keep adopting, and I love it because there's plenty of kids that need a great home and need that love, but likely if you're a head of household status, it is temporary. That is not a permanent status. And when you switch from head of household to single, that's not a choice that you just raise your hand and say, all right, I think I'm ready. No, this just happens to you. Nothing's changed. Your job didn't change. Where you live didn't change. You didn't move. You didn't change withholdings. You didn't get a notice from the IRS. It's just, and there was no conscious decision. It just meant, oh, that dependent is no longer a dependent. Fine. Okay. You're no longer a head of household. You're filing single. And this has huge, huge tax implications. There's 3 of them that I want to point out, and then I'm going to give you the antidote, the way to help. So the very, very first one is the obvious one, and that is you lose any potential tax credits that you would otherwise get from having that dependent. So in order to be head of household, you need to have a qualifying child, qualifying dependent. And back when the new tax laws were put in place a couple of years ago, that child tax credit for any child younger than age 17 was only $1,000. Well, it jumped to $2,000. That's huge. But the other thing they did is they gave a qualifying dependent child credit as well. If you still have a dependent, but they're now age 17 or higher, you get $500 tax credit. You get a $500 tax credit. That is huge. On top of that, if that child is in college and your income is below certain thresholds, you could get college tax credits, college credits that can be significant, upwards of $2,500 on your tax returns of real money, credits or dollar for dollar reductions in your taxes. So think about this. You're head of household because you've got a senior in college. Well, they're a dependent, so you get a $500 tax credit. They're in college and you qualify for the American Opportunity Credit, that's $2,500. That's a $3,000 change in your tax situation. That could mean all of the refund you're getting. It could also mean it's the only part of the refund you're getting. You're getting a $1,000 refund. Well, $3,000 of that is tax credit. Therefore, you could be actually owing $2,000. That's an enormous change when you shift. You need to be aware of that. What are the tax credits that you're getting because you're head of household and have that dependent? You need to be planning ahead, being aware of when those go away when you switch to a single filer. The second big change that happens when you go from head of household status to single filing tax status is not as severe as that tax credit one, but still makes a big impact, and that is 90% of all taxpayers file a standard deduction. Okay, and if that's you, like the majority, then when you switch from head of household to single, your standard deduction goes down. You have less deduction just moving from head of household to single. Again, your income stayed the same, your job has stayed the same, and now all of a sudden you have less deductions. If you're a head of household filer and you don't itemize your deductions, your standard deductions are around $18,000, between $18,000 and $19,000 per year. That's pretty good. When you switch to a single filer, that drops to around $12,000. That's a big change. Depending on your tax bracket, that $6,000 to $7,000 of lost deduction can mean $1,000, maybe a couple $1,000s of extra tax that you will owe. Again, you didn't do anything, you didn't make any conscious decision, you just no longer have a dependent and you go from head of household status to single filer. That's the second big change you've got to watch out for. The third big change, and this one is huge, and I'm going to get a little geeky, I'm going to share with you some of the numbers, but when you switch from head of household filer to single filer, and again, you're not making this choice, it just happens, the tax brackets get smaller. That's right. Head of household has its own tax brackets. Just like married filing jointly has its own tax brackets, it's the same rates, 10, 12, and so on, but the amount of income that you can make within each bracket, it's wider, okay, for head of household, and it shrinks for a single filer. Forgive me for doing this, but I got my cheat sheet here. We'll put it up on the screen as well for you. But if you're head of household, after all of your deductions, the first 14,000, call it, you pay 10% on. From 14,000 up to around 53, 54,000, you pay 12% on. And then from 53, 54,000, somewhere in there, up to around 85,000, you pay 22% on. Those are your tax brackets. Those are the bands of the tax brackets. That's for head of household. When you switch to single, you're in the 10% tax bracket only on the first $9,875 that you make. That's it. So you have less money being taxed at 10%. And then the 12% bracket goes from that number up to 40,000. And all of a sudden, you're all the way out of the 12% tax bracket. The 22% tax bracket goes from 40,000 up to 85,000, approximately the same number. But you have more income taxed at the 22% tax bracket as a single filer than you would a head of household. So the 10% bracket is smaller, the 12% tax bracket is smaller, and the 22% tax bracket is bigger. You are paying more tax. That equals something geeky called a higher effective tax rate, or a higher average tax rate. Again, you didn't change jobs, you didn't do anything else. It's just all of a sudden you're a single filer and you're in a higher tax bracket. So those are the nasty three. And guess what? They might all happen at the exact same time. When you switch from head of household to single filer, any tax credits gone. Your standard deduction drops and your income brackets shrink. Your tax bracket goes up effectively. That is a dangerous combination, and if it catches you by surprise, that can create a financial crisis. You want to avoid that. What's the way to avoid it? Do tax planning every single year. Sounds so geeky. That's why you got to work with someone who absolutely loves it and who understands your situation. That's your certified financial planner, and they can take a look and say, all right, this is the year you're changing from head of household to single. Or, hey, we've got 3 more years left at head of household, so let's make sure we're doing these tax strategies. Right now you need to do Roth and HSA and so on, and when you switch to single filer, you're going to be switching over to pre-tax, blah, blah, blah. They can craft the right strategy and make sure that you're not caught off guard and surprised. I mean, the best way to do it is know exactly when you're going to be switching from head of household to single, and in January, increase your withholdings. Better yet, be aware of that from a budgeting standpoint so that when you increase your withholdings, you know that drop in your take-home pay isn't going to throw your entire budget out of whack and throw you way off pace on your on your financial goals. That's the proactive work that you do with your comprehensive financial planner. That's their job. This is their job to plan for this for you. So reach out to your CFP, make sure you're doing proactive tax planning so you avoid surprises, capture opportunities. You don't have a CFP in your life or also need a CPA? We've got both on our team. They collaborate, work together. Find us online, Korhorn.com, that's Korhorn with K, wisemoneyshow.com, you can find us there as well, and info@korhorn.com is where you can send us an email. All right, there you go. Go out and take your next wise step in your financial life.